The second quarter was absolutely a continuation of the first. So momentum in the businesses, on the revenue side, also just client engagement, market share growth. We're meeting our commitments to shareholders around expense management. So we've delivered the second quarter in a row at a $5 billion expense base. And we're managing the balance sheet and also capital ratios, essentially powering through the setback that we had, which was the Postbank litigation provision.
And that's looming very large over this quarter and potentially the next. So what can you give us in terms of an update, in terms of discussions, where that is right now?
Look, little to update. Basically, with the court has been going through the timeline that was laid out back in April. So we've provided a brief. We're waiting for the written conclusion, and then we'll react. I'm sure the claimants will react as well to that. It's very hard to assess really the direction of travel from here. We'll have to see what the judgment or the next statements from the court sort of tell us, and also what the posture of the claimants is going to be.
And is that 1.3 the sort of worst case scenario? Is that the sort of ceiling on?
Yeah. We've booked to the maximum claim. We have interest that accumulates over time, but we've essentially booked to the maximum claim.
And if this group of investors does win, does it open up a can of worms in terms of other litigation from Postbank?
Well, look, not on Postbank. I mean, there's one other sort of unaffected claim that we think is extremely remote. But no, what it does open up is some uncertainty in the German takeover code, which is one of the reasons that we've been fighting this case for 14 years. And so there's some interesting questions of law, because I think the interpretation being pursued here is very novel. And hence we're vigorously contesting the claim. And
so you have contested the claim, saying that Deutsche Bank has done nothing wrong. Do you think that indicates that the sort of regulatory system leaves room for investors to take advantage of this? And how does that bear on kind of your thoughts about taking over businesses in the future?
Well, it does introduce risk, and we think this transaction isn't necessarily alone in having the fact pattern that we went through, and hence I think getting certainty back into the German system about this type of takeover would be sensible. And for us, it's about contesting the claim, hopefully delivering some better news to shareholders around this. But managing it in the best interests of shareholders and also the legal matters at stake here.
And what shareholders are also going to be caring a lot about today is how it's going to bear on your sort of buyback plans. And there was sort of some ambition for the back half of the year. It seems more remote. How is this going to bear on your payouts?
Well, look, we're really happy with how we've been able to manage through it in the second quarter. So with a CET1 ratio of 13.5%, essentially we more than offset the impact of the litigation provision. That sets us up well, I think, going into next year to continue delivering on the commitments we made to shareholders around a capital distribution trajectory. As you say, for this year, I think prudence would dictate that we step back from seeking a second repurchase authorization. We've already returned, $1.3 billion to $1.5 billion to investors so far this year, and so we think we're demonstrating an ability to stay on track.
And so the $8 billion through 25 is still intact in terms of return.
We've set a goal over that 5-year period of $8 billion. I think we're in a position to significantly exceed that $8 billion, even with the setback we faced this quarter.
And then a question: does a settlement on the question of Postbank, could it mean a buyback in the back half of this year if that?
If there's a positive outcome, the judgment is expected on the 21st of August, so we'll be looking for that. And if in the event that there's a positive outcome, that would certainly change our positioning.
Okay, and then outside of that and into the sort of the broader business, looking at the outlook, what are you seeing in terms of FICC and trading? And what do you see this quarter, and how do you see that developing?
Well, it was an interesting quarter. We're actually pleased with our performance in the quarter, and we've continued just to execute on our strategy of sort of building and investing in the business, and that's showing in market shares and momentum that we had. For us, a relatively weaker environment in rates and FX, especially in the early part of the quarter, sort of offset still strong growth in emerging markets and credit trading. And so that sort of netted out to essentially flat to last year. Looking to the back half of the year, I think you're going to see more directionality of the rate environment, and maybe a little bit more volatility that would be helpful again for the rate and FX complex.
And then also you've talked about sort of interest rates, the net interest income. Sort of obviously we've been expecting that to taper off. It's been a little bit slower, but also loan growth a little bit slower too. Have you found this whole cycle to go a bit slower than anticipated? And do you expect that to sort of the tail on net interest income to be longer?
So lots of elements of that. So the upswing was much quicker than people anticipated. So we sort of all navigated through this very rapid rise in rates. As you say, yes, the period of time waiting to discover what terminal rates were, the plateau, and now the anticipation of a downward movement in rates has all gone a little slower than one might have expected. Frankly, that's been good for the business. So as we look at 24 performance, our net interest income has been an upside surprise, and we think it'll remain an upside surprise relative to our expectations coming into the year. We thought net interest income would be down reasonably significantly this year. As it stands today, we're looking at net interest income in our banking book segments that is traveling relatively flat to last year. So that's a big upside surprise for us.
I just want to touch back quickly on FICC, because you did so well last quarter, really bucking the trend, and then this quarter kind of on the lower end with some of your competitors. And the sort of vastness of the FICC universe, why is that in terms of where?
If we look at sort of trying to compare from what we can tell of our competitors in the product mix area, securitized products in the U.S. seems to have been a strong area, and that's one we don't really participate in. So that's probably the main driver. Also, you've got to look at the comparison year. So our second quarter last year was quite strong on a relative basis. So we're looking at sort of 2-year trend comparisons where we're very in line. And as I say, very comfortable with how the business is performing.
And obviously you are the great lender to sort of Germany Inc. And looking at sort of loan growth. What is that telling you about the state of the German economy, where you're seeing weakness within the different sectors? Is there any sort of hope for strength anywhere?
Well, as you said a moment ago, loan growth has been more sluggish than we would like to have seen. We'd been anticipating it a little earlier than now. And that's true also in Germany. We still have had a net decline in our mortgage book, for example, this quarter. Some of that's deliberate, some of that's sort of the market environment. I'd say the German economy has found its footing, and so we're seeing growth now. It's marginally positive, but we think accelerating now in the second half and into 25. There have been some weak sectors. There have been areas, especially in the smaller enterprises, where you've seen an increase in defaults, but it's still at a very marginal level, and we think that this process of stabilizing and sort of a foundation for growth is ongoing, and we're encouraged by what we see.
And I want to talk also a little bit about the ECB, because we had a story out overnight saying that they were looking to have the amount that banks have to provision for leverage loans. Is that something that you have pushed back against with the ECB and been in this discussion, and do you welcome that if they do in fact move forward with it?
Well, I'd say, I mean, the history here has been 5 years, frankly, since the ECB first started publishing its expectations in leverage lending. And I actually view that whole dialogue to have been very constructive and productive. So we've made lots of process and reporting changes. We've looked carefully at the book, and that is ongoing. There have been additional examinations and feedback. It's a valuable process. It sort of makes us better at what we do. To be honest, on individual provisioning sort of decisions and methodologies, there, as you can imagine, it's a vigorous debate with the inspection teams in looking at those methodologies and the results. We'll always take feedback and then react as we see fit. I think it's important to say, though, we think the allowance that we operate with, that we have today, is prudent and adequate for the risks we see in all of our books, including leverage lending.
And I'd like to understand from kind of your perspective, if they don't diminish those, what they're sort of asking for, what is the consequence in terms of the businesses that you can do or are willing to do?
Well, look, I think we've already put in the process and underwriting changes that they were looking for. Again, this goes back 5 years, so it's been a process of steady improvement. For us, leverage lending is an important part of our business and engagement with clients. We think it's also an important financing tool in the economy to help sort of change of controls and new investments in sub-investment grade areas. So it's something that we want to continue to participate in, we think we're good at. But appropriately, the ECB is looking for it to be done in a sensible, prudent, well-controlled way, and that's an expectation we're working hard to ensure we meet always.
And I just want to touch quickly also on some of the political questions that we're seeing all over the world. This obviously is a sort of a big thought for investors and clients. In terms of what clients are saying to you, what is the sense of sort of their view on what is happening, particularly in the United States election? How do they sort of feel about it? What are they most concerned about?
Well, look, we came into the year knowing it would be a year of enormous election sort of results and changes, half the world's population, going to the polls. And it hasn't disappointed, I'd say, in terms of the dynamism of what we've seen in the democracies. I would say that looking at the US specifically, and perhaps Germany's reaction to it, people naturally are looking at the possibility of a Trump victory and what that means from a policy perspective, how it'll affect Europe, how it'll affect the economy, trade, the defense sort of situation that we live within, and are getting ready to make adjustments that might require. I think that's a healthy process of preparation.
Would you say that clients favor an outcome?
I don't think I don't hear clients favor one way or the other. I think, as always, certainty about the environment that we're operating in and stability is the best thing clients can look for, and dynamism in the economy is good for our clients and for the society as a whole.
And in terms of betting on whether or not there will be more or less dynamism in the economy, does the result of the European election lend a belief that it might to your clients, who are obviously largely industrial? There's a lot in the sort of commission in terms of their ambitions of industry and defense. What are they seeing there?
Well, look, the program, I have to say, is encouraging. I mean, so that Brussels in the second von der Leyen administration is looking at competitiveness, economic growth as core pillars of their program. To us, that's encouraging, and I think the economy, our clients, are looking for that type of leadership. Also, a reduction of bureaucracy and regulation. Those are all things that I think would stimulate growth here in Europe. So the question is really how much of that program can be put into place. For us, the Savings and Investments Union, used to be Capital Markets Union, is obviously a key part of enabling the banking sector or the financial services sector to help provide our part of that, or contribution to that, which is financing the economy, the digital transition, sustainable transition. I think Brussels does have an opportunity to unlock all of that for us.
Would you say we're the closest we've ever been to kind of an active and real discussion on Capital Markets Union?
I'm not the expert, but there's been some false dawns, as we all know.
Yes.
And so I think we just need the decisiveness, the leadership, even if it's smaller steps. Sort of forward progress, can tend to sort of build momentum, and that's certainly something we would love to see.